Good evening, everyone, and welcome to this quick session on mastering FP&A reports brought to you by FP&A Professionals Institute. First of all, thank you for your trust. You've taken out your valuable 60 minutes to spend time with us here today. Pat yourselves on the back for taking action. A Harvard study says that less than 3% of the people take active action to develop their careers, and no wonder less than 3% of the people are leading the world's organizations. So pat yourselves on the back for taking that action and make sure you stay through till the very end for you to gather everything that we're trying to share here today in this short session. A little bit about us before we begin with. My name is Dhawal Parvatikar. I'm a qualified chartered accountant. I've also completed my one-year general management program from IIM Ahmedabad. Over the last 16 years, I've served as a CFO and a finance leader across India and in the Middle East with various multinational corporations. I'm now the co-founder and lead faculty at FP&A Professionals Institute. I've been an active online instructor over the last 6 years, probably thousands of hours of Zoom training, and I've coached more than 5,000 professionals on various topics like P&A, finance business partnering, data storytelling, CFO career coaching, and much more. Those are the brands on the screen that you see that I've worked with, most of them the largest in what they do. I'm also seen frequently in the events across the Middle East, the CFO events across the Middle East, where I've gone in as a panelist, as a moderator, as a host. I've built a community of more than 200 plus CFOs as well in the Middle East. We actively are connected. We meet every quarter and discuss and share latest insights as well. I'm joined by my co-founder, Asif Masani. Asif, a quick introduction from your end.
Yeah, thank you so much for having me, Dhawal. And quickly about my background, I've been working in finance very specifically in FP&A for more than, I would say, 12 years now. And my most recent role was the FP&A lead for one of the largest edtech companies for their APAC and India region. And that's when we decided to start FP&A Professional Institute, which was back in 2022, end of 22, beginning of 23. And over the last 3.5 years or so, we've managed to train more than 5,000 students across all of these certifications courses that you will see in the next screen. So happy to partner with Dhawal and looking forward to this session today.
Thanks, Asif. One thing that Asif and I share is our extreme passion for helping finance professionals get to the next level. That's what motivated us to quit our high-paying CFO and FP&A leader jobs to start FP&A Professionals Institute with a mission to shape the next generation of finance professionals. So what are we going to cover today in the 60 minutes that we have? Again, I would encourage everybody to get rid of all the distractions. We'll start with a quick introduction of what is FP&A, why is it gaining so much of prominence, why CFOs are looking for FP&A talent today. Then we'll try and understand specifically the management reporting section in FP&A. What are the different types of management reports? How companies are using management reports? What are performance management frameworks? We'll try and understand all of these things. And then also, it is equally important to understand your audience, right? Because the senior management looks for different kind of reports and insights. The middle management looks for different kind of reports and insights. So we'll try and understand a little bit about our audience as well. And finally, we look at some different types of reports, examples, performance management framework examples. We'll try and spend enough time on understanding examples as well. Of course, we won't be able to do or show anything from start to end, but we'll definitely show you some different kind of report examples that various companies are using in their day-to-day management reporting area in their FP&A roles as well. So all in all, it's going to be 60 exciting minutes. So get rid of all the distractions and let's focus. So understanding the CFO office, right? So if I have to break down the responsibilities of a CFO, I can narrow down on three pillars. One is the controllership pillar, which is all about maintaining the routine hygiene of the accounting function, which is about AP, AR, statutory audit, internal audit, SOX audit, and all the different compliance elements that come in the controllership function. Then comes the treasury function, which is all about banking relationships, cash management, working capital management, forex exposure. All of these come under the treasury function in the FP&A in the CFO's office. And then finally, somebody needs to keep an eye on the performance of the business. So that is where FP&A comes into play, where with activities like budgeting, forecasting, various kind of management reportings, financial analysis, commercial analysis, the FP&A team supports the CFO and other senior business leaders in the company with various insights, timely and accurate insights so that they can take informed decisions. So this is roughly the CFO's office. And that's why FP&A also kind of enjoys this unique position of sitting very close to the CFO's office as well. Now, what are some of the key components in FP&A? Now, there could be dozens of smaller set of activities within the FP&A function, but all of them can be narrowed down into three buckets. One is budgeting, which is an annual business plan exercise where we are trying to come up with a plan for the next financial year, right? Your estimated revenue, your estimated costs, your estimated operating profit. Forecasting is all about tracking the ongoing performance of the business, where we are talking about a monthly forecast or a quarterly forecast. For example, let's say if I'm following Jan to December as my calendar year, and I am preparing Jan to March actuals, after my Jan to March actuals, I will prepare something called as a 3+9 forecast, which is basically 3 months of actuals and 9 months of forecast. So this way, I'm able to keep a continuous track on the performance of the business. Some companies opt to do it monthly, or some companies opt to do it quarterly, depending on the size and complexity of the business. And then under management commentaries, you will be doing various kinds of analysis and publishing reporting packs and sending them to different decision makers. It could be business unit head, general manager, CFO, CEO, HR head, different uh, stakeholders in the company. And in order to execute these management reports, you will end up doing either a variance analysis or a profitability analysis. Now, variance analysis is where you're looking at different set of comparisons, okay, comparing various set of numbers and trying to understand the business reasons for these variances. And profitability analysis is where you're breaking down the entire corporate profit into multiple subcomponents to understand which subcomponent is performing better and which is lagging behind. And we'll touch upon variance and profitability analysis as we progress in this session as well. Now, let's get started with the fundamentals of management reporting. So in the pillars that I mentioned to you, budgeting, forecasting, and management reporting. So today we'll be focusing completely on the management reporting section, trying to understand the different types of reports, some examples, some concepts, some frameworks on management reporting within the larger umbrella of FP&A. I'll let Asif cover the different types of management reports.
Yeah, so you want me to share the screen or you want to continue?
I can continue, Asif. I can bring the screen, or you want to share?
Okay. No, I think it's okay. We can continue.
Okay.
So let's bring it one by, or it's okay. You can keep it all at once. Okay. So now many of you might have heard management reports while working in finance, and some of the common names that you might have heard could be management information system, or some people call it the departmental income statement, or some people call it a natural P&L statement. So these are some of the common terminologies that you might have heard while referring to management reports. They are all your management reports. And one of the important things why, one of the important reasons why these reports are important is because they are used by almost everybody in the organization, right from the analyst to the CEO. And you might be seeing people refer to different terms which are only used inside the organization. And if you talk about those terminologies with somebody outside the organization, they may not be able to relate. That's how it creates a common bond or common language for people who work inside the organization. Also, it is presented by logical categories or natural categories instead of following any accounting gap like US gap or IFRS. Compare it to your financial statements like your P&L, income statement, balance sheet, your cash flow statement, statement of retained earnings, which are financial reports required and prepared for the accounting, to follow the accounting gap, to make sure that the company presents their earnings to the shareholders, following a specific accounting principle and accounting methodology. Uh, that is very different from management reporting, where you do not need to follow the accounting gap, and the management reports are mostly structured in a very similar way how the business is structured, in the same manner in which the different departments are structured in the organization. So that is how the management reports are different from your financial reports. Okay, so now that you have understood what the management reports are, let me also cover some of the uh, qualities, or I would say some of the things that would separate a good management report from an ordinary one. Okay, so if you want to learn how what some of the qualities are of a good management report, these could be one. Okay, ideally your report should fit on a one pager, or it should be a one page report, or it doesn't necessarily has to be one page, but it has to be as short as possible. Why? Because these reports are being referred by busy executives, and they usually may not have the time to read 50 pages of slides or 100 pages of a deck. Okay, so they may want you to summarize the key insights and the key takeaways in one or two slides, or whatever is the minimum required for the communication to happen for the updates on the management numbers. So that is one. It has to be shorter, preferably one pager. Second is that it has to be decision focused. Every report or every slide should answer a question that usually is being discussed by the senior person who is going to review that report or support a decision that he or she is going to make. Okay, so before you create a report, ask yourself what decision will this particular report help, okay, or who this report will help in the organization. So it has to be decision focused. It has to be intuitive to understand. So if someone needs, I would say, if someone is not able to understand your report by the first read of it, probably you have failed, and it's not a good management report because it has to be very easy to understand with clear labels, logical flow of layout, visual cues, color coding, and it has to be very intuitive to understand. In terms of the look and feel, also, Dhawal, if you can continue the bullets. In terms of the look and feel, also, it has to be standardized in terms of you should be making sure that you send the report in the similar format as you have been sending it in the previous months. I think you can bring it all of them, Thor. You should be bringing you should be making sure that they are consistently sent in terms of the formatting, because when you're sending the reports on a frequent basis or on a monthly basis, in many cases the senior management get used to looking for some numbers in certain pages or certain parts of the report, and if you change that on a month basis, usually doesn't create a good impression, because you are making sure that people are consistently referring your reports, and usually you should make sure that you don't change the format again and again unless there is a good reason to do so. Simple language, we already discussed that. In terms of the frequency, it could be either on a monthly basis. Some reports could be on a quarterly basis if they are not that important in terms of the area. So it could be quarterly, it could be monthly. Some reports might be required on a weekly basis. For example, reports relating to your revenues, or reports relating to some of the important KPIs of the organization. There you may have to do more frequent reporting. It could be more than a month, it could be weekly, it could be daily as well in many cases. Okay, so whatever is makes sense in terms of what the senior management would expect you to do in terms of how frequently. Nowadays you have dashboards where they can go and self refresh and see the changes in almost real time. So a lot of the reports are also now become very frequent in terms of they can log in and they can refresh and they can see the changes almost every day in many cases. Okay, accuracy is important. So although your reports need not be 100% accurate, but if your data is wrong, and if somebody points out that your numbers don't make sense, or your numbers are different from what I have, and if you're not able to justify that, or if you're not able to uh, give a good enough reason that why your numbers are different from what somebody else is presenting, then it will usually erode that trust. So you should make sure that you are confident of your numbers. Even if it is not 100% accurate, you should know what are the sources. And if somebody else is using a different source, why that source and your source is different. And you should be able to easily be able to answer any questions on the quality of the data or the quality of the numbers that you're presenting. So these are some of the good qualities that you should keep in mind while you're designing any management report.
So the next comes understanding your audience. Now, broadly, all the audience that you will be interacting with, whether it is cross-functional stakeholders or within or outside of the finance function, they can be clubbed into three categories. Okay. And here's a quick audience by presentation guide, which will tell you what kind of a presentation needs to go to what kind of an audience. One could be senior management or decision makers. Here, they would expect a strategic dashboard. They would expect something which is high level, goal focused, and something where they need a decision. Think of it like writing a WhatsApp message to your CEO and asking for a yes or no decision or asking for a certain decision, right? So that is what they look at. They don't have time to analyze multiple reports, 10 pages of reports or Excel sheets or decks or even a Power BI dashboard and all of those things. So they need something which is very intuitive and something which is very easy for them to decide. And then mid-level managers, now they have time, right? So they would appreciate a rich analytical dashboard, a rich comparison with multiple drag and drops. They have time to go deeper, diagnose problems, understand. So give them an analytical dashboard or give them some interactive dashboard which they can play around with and analyze and go deeper. And then comes the operational or the tactical staff. Now, operational or executional staff are not necessarily thinkers. You don't want them to analyze something or think something. You want them to act, right? So very simple that, okay, if the temperature goes beyond this, then it will go become red, then you stop it, or then you cool it down or something like that. So as simple as that. So you need to give them something very real time, tactical and action oriented. So you don't want them to take a 3 month, 6 months view. That's not their job. Okay, that's the planner and the strategic management's job, right? So here's a quick audience by presentation guide. Strategic senior management, give them a strategic dashboard. Middle management, analytical dashboard, and operational, then give them a operational or an executional kind of a dashboard as well. Now let's look at some of the most common management reports. Asif.
Yeah. So these are some of the most common ones in terms of FP&A, what you would typically come across. So we can bring them all together and then I can share my screen. So your month end and the quarter end reports, and we'll take a look at examples of how they look like. Flash reports, risk and opportunity analysis, and then we'll also share a couple of frameworks like performance management frameworks like the balance scorecards and the OKRs or the objectives and key results. So these are some of the common reports, not an exhaustive list. So you have uh, dozens of reports that FP&A people do. So usually they do different reports for different functions. So there could be a headcount salary report, there could be a sales and marketing report, there could be operations related report depending on the organization. So usually there are more reports, but these are some of the common reports which usually are most important ones that you would see across in many organizations. So what we'll do is we'll share some examples of these reports so that you can get an idea of how they look like. So let me share my screen. So how do you let me know once you see the screen? Okay, so let me show you an example of one of the month-end report, one-page report that we talked about, right? One-page report, which is for a banking organization. Okay, so although this is for a banking organization, you should understand how this is constructed. So I'll explain you what are the components of this report, and you could create such report for any organization or any other industry also. Okay. So let us first understand what are the different elements of these report. Okay, or what are the different elements of this report. So if you notice, it is one page report as we had discussed. It has to fit in one page or it has to be short, uh, so that it's easy to refer on an ongoing basis, on a month-on-month basis. So it's a one-page report. Then you have two parts to this report. The top section is looking like a very similar to what you have as a P&L or an income statement. Although it's not a complete income statement, it's a form of a abridged or it's form of a summarized income statement. And at the bottom, you have something called as drivers or key performance indicators or KPIs. Okay, so you have the income statement on the top, and then you have the KPIs in at the bottom. Okay, now within the income statement also you have the revenue section and the expenses section. So in the revenue section, you have the top three revenues line items for that particular company, and in the expense section, you have the top five or top six expense line items. Okay, in this case, because this is a banking organization, the top three line items are your net interest margin. Net interest margin is something which is your difference between the interest that the bank earns on the loans that it lends and the interest on the deposit that it pays to its customers. So that is the spread that typically the bank earns, which is called the net interest margin, which is one of the major revenue sources, I would say, one of the biggest revenue sources of a retail bank. Then you have transaction fees. Transaction fees are fees on different investment transactions that the bank supports. For example, if you have an account with the bank and you are bank is holding your equity and your mutual funds and you're transacting and buying and selling that with the bank, they will typically charge you some transaction fee. Or if you are buying an insurance policy from the bank, typically a bank would charge some commission on that. Okay, so the net interest margin, the transaction fees, commissions are typically the top three revenue line items for any retail bank, and you have those in the retail in the revenue section. Okay, similarly, you have the top five or six expense line items. I'll not go into each of them in detail, but you can visualize. Typically, for a bank, you have your salary as one of the biggest costs. People are one of the biggest costs for a bank. Platform and technology is another bigger cost, which is for your mobile banking and for your internet banking. uh, Branch related costs, which is rent utilities for the branch, which is the physical infrastructure of the bank. Fraud related losses. Many times banks usually cover any fraud related losses the customer has gone through because which was not the fault of the customer. And then there are admin expenses. So these are typically the top 5 to 6 expenses of a retail bank. So you have your top three revenues, top 5, 6 expenses, and then at the bottom you have your key drivers or KPIs. Now, if you notice the color, which is the red color, and your net interest margin and your end of period balances of loans and end of period balances of deposits are in the same color. What does this mean? Your net interest margin typically is driven by your interest rate and your loan and the deposit balances. So more the loan balances and more the deposit balances, more or less the bank usually would make a good or more interest related revenue. Okay. So more the bank lends, more the bank collects deposits, the more is the interest related revenue. That is what the red color is denoting, which means that these two are interrelated. Okay. Similarly, the green lines, the transaction fees and the commissions are linked to your end of period asset management and your insurance policy sold, or number of the policies, insurance policy that the bank sells. Similarly, your salary, which is a blue line here, is very much related to the headcount. If your headcount usually goes up, the salary expenses will go up. Similarly, you try to correlate each and every line item of your income statement, okay, which typically is called as the financial metric. Okay, so all these are your financial metrics. So you try to correlate your financial metric with an operational metric. So all these key performance indicators are your operational metric. And when you do the variance analysis commentary, you try to explain the variance between the actual and the forecast, or between the budget and the actual, or between the forecast and the budget, by talking about how does the change in the financial metric is driven by the change in the non-financial metric or the KPI. So typically, this is the structure. Some companies would have actuals first and then the budget. Some companies would have budget first and then the actuals. Typically, comparison versus actual versus budget, and also percentage growth. So this is typically how most of the companies would have their management report set up as a one-page report. Okay. Now, if you want to do this for any other organization, you can simply replace the revenue line items. Say, for example, I want to do this for a FMCG company called, say, a company which has three different products. Okay, so I could say product one, product two, product three. So revenues from these three different products would be the top three revenue line items. Okay, and expenses could be, if it's a product company, it could be the COGS. Under COGS, you could have your raw materials, direct labor, and manufacturing overhead. Okay, and then your sales and marketing, and your other admin expenses. Okay, so similarly, you could create such reports for any organization if you know the top three revenue streams and the top 5 or 6 expenses, and then you could figure out what could be the drivers related to this. For example, for these particular products, this usually would be driven by volume and price. Okay, so number of units of product one, a number of units of product two could be the drivers for the revenue line items. Again, cost of goods sold, depending on what are the components of the cost of goods sold. If it is raw materials, it could be the quantity of the raw material, it could be the pricing of the raw material, depending on what the cost of goods sold is. So you have to figure out what are the top three revenue items, what are the top six or top five expense items, and then figure out what are the drivers that are we need to affect those lines. And when you do the commentary, you should be able to explain how the changes in the financial metrics are driven by or how they are affected by the non-financial. So this is how typically a management report would look like for most companies, although not exactly the same, but the structure and the format is typically very similar. So I'll take a pause and we'll go to the next report in a bit. Okay, I think the next report what we had in the in the slide that we saw was on the. Let me maybe share a couple of reports. Okay, so there was a balance scorecard that we saw. Okay, so what does a balance scorecard do? So in terms of the balance scorecard, measuring the performance of the company in four different areas of it has four different pillars. Okay, so first pillar is related to the customer. Second pillar is related to the internal processes. The third pillar is related to your learning and knowledge. And the fourth pillar is related to your financial performance or your revenues and your return on investment and the return on equity. So what do you do? For each of these pillars, you create or you set an objective. Okay, and for each of the objective, you also set how would you measure that objective, and have a target for that particular objective and measure. And then you measure the actual numbers, and then you present or you report how you have performed against the target. Okay, so let me take one example. For example, on the customer pillar of the balance scorecard, which is one of the four pillars or one of the four areas, your one of the important objective is that the delivery of the product should happen on time. Okay, or on time delivery is one of your key objectives. And you decide you will be measuring this objective by calculating or by looking at something called as the delivery failure rate. Okay, delivery failure rate meaning how many deliveries do not happen on time as a percentage of or on out of every 100 deliveries, how many deliveries do not happen on time. Okay, your target is to keep the delivery failure rate below 2%. That is your target. And if you achieve right more than that, or if you say if you are able to keep the delivery rate below 1%, then you would probably say you have overachieved in terms of the target, or what you've done is more than what you had set as a target. However, if the delivery failure rate was higher than 3%, you would have said you missed the target, or you would have colored it red in terms of your performance evaluation. So you can do that for each of the areas of the balance scorecard, you can have one or two objectives, and for each of the objectives, you can have one or two key, I would say, for measures, and then for each of the measures, there is a target and also the owner who will be responsible to meet that or achieve that target. Okay, so this is typically how a balanced scorecard would look like. Okay, let me share another example of a framework which is a very popular framework which is called the objectives and key results. So let me share an example. Okay, so this was initially used by Google back in 2000, started used by Google initially in 2004, 2005. And once Google successfully used this particular framework, a lot of the other companies in the US, especially in the tech industry, started using this framework as well. So once Google started using it successfully, a lot of other companies have adopted, and today in 2025, 2026, it has become one of the very popular frameworks, especially if you're working with companies in North America and Europe. What happens in the objectives and key results is you define what are the top goals of the company every quarter. So you have an annual budget in place. However, annual budget usually what is seen that it becomes outdated after a couple of months. So you need to make sure that you have shorter periodic targets. So in this case, you are doing a quarterly target. Yeah, so for example, in this case, the goal of the fourth quarter for the company is $100 million of revenues, 6,000 new customers, and maintaining a retention rate of 50% again. So these are the most important goals of the organization. And this is how the organization or the CEO will be judged when you evaluate the performance of Q4 at the end of the Q4. Okay, so everybody in the organization knows what are the most important goals of the company, and then what are the goals of the different teams or the different departments in the organization. For example, there are three different departments in the organization, and how this $100 million will be achieved. So some of it will come from Department A, some of it will come from Department B, some of it will come from Department C. Okay. So typically you have the objectives and key results. So these are your objectives. These are your objectives which you see in blue, which are your targets. And then key results are usually defined. How would you achieve those objectives? Okay. So how would you get the 25 million in revenue and 3,000 new customers and get, right? How will you do that? Okay, so the key result areas would be to for the in this particular department, the SEO head needs to figure out how do you get 1,000 new customers, or to be able to get 25 million in revenues for this department, there need to be 10 new products launched. Okay. So this is how OKR typically looks like compared to the balance scorecard. It is fairly transparent. What I've seen in my experience is companies that use balance scorecards typically work more in silos, so you typically don't have access to the balance scorecard of other departments. If you're working in Department A, you may not get access to the balance scorecard of Department B. As a finance team, you may have access to all the balance scorecard because you are working in finance. However, the other departments usually don't have access to the other department's balance scorecard. Typically, that is one major difference that I've seen. While in the OKRs, you have these published on the internet, and anybody and everybody in the organization can see what are the OKRs of each and every person in the organization. You can just go onto the internet and just by the employee ID or by the name of the employee, you can see, okay, what are the objectives and key results of that particular person or of that particular team. And usually that rolls up to the organization OKRs or company's goals. So yeah, these are the two common frameworks that are used for performance management. And I think you shared some examples on that. Okay, I'll take a quick pause and see if Dhawal, we want to go back to the slide.
Yeah, Asif, did you cover the monthly and the quarterly reports on the slides? I think they're on the slides.
Yeah, I think we saw the examples, so I don't want to. That's fine. We
Okay,
shown
okay.
the example, so I think we can continue with the. Let me
Yeah.
stop sharing my screen.
You want to cover the risk and opportunities report?
Yeah, I think we can cover both flash and the risk and opportunities.
Okay.
So, in the interest of time, I'll not be showing. If we get into the Excel, it might take a lot of time. So, let me talk about a couple of more important or common reports. Instead of important, I'll say more common reports. So, flash reports are typically periodic snapshot of your key financial or operational data. Typically, it is shorter than your monthly report, so it's more frequent. So think of it as a weekly report or a daily report that you are sharing for only the most important areas or most important KPIs. Okay. It helps you bridge the gap between month-end reports, typically again one pager or shorter report, and it only covers a critical business insight. Okay, so what typically you do is you have a conversation with your key stakeholders. Okay, key stakeholders could be your head of sales, head of marketing, whoever you are working with in your particular role. So depending on what role you are in, if you are looking at the revenue side, you might have sales and marketing as your key stakeholder. If you're working on the expense side, it might be somebody on the operation side or somebody on the accounting side as your key stakeholder. So depending on who your key stakeholder is, you understand what their requirements is of frequent reporting, and based on the conversation that you have, you can design a very tailored flash report that you could create and then you could agree upon, and then that is what you could use for your more frequent reporting. It could be weekly or it could be a daily or it could be more frequent report compared to your month-end reports. Okay. Another analysis that you typically would see FP&A people do is risk and opportunity analysis. So let's take an example. So on the slide, you see a tracker, Excel tracker example. Okay, so consider that to be an Excel file and you have different columns and you're tracking the risk and opportunity line items. Okay, so there's one example of risk and one example of opportunity. Let me talk about the risk item. So in this example, you losing one of your bigger clients is the risk that you have identified. Okay, so client X is giving you 20% of your revenues, and there are some issues that you have noticed that the client X is having with the quality of the product or quality of the service, and the client X has given you a warning or notice that if this doesn't get solved, I'll probably leave the organization and take my business somewhere else. Okay, so that is a key risk in this particular example. And your description says that possible attrition of client executive service delivery issues. So you are describing what the risk is and also what the company is doing or what the business team is doing to make sure that the risk is mitigated, or what are the actions that are being taken. If there are no actions being taken, that is something that you need to highlight, or you need to make sure that somebody is aware of it, and then there's some action someone in the organization is taking to mitigate that particular risk. Okay, category is basically where that which line item is that going to affect in your forecast. New or change meaning, is it a new risk or was it known earlier? Okay, if you write new meaning you did not know that earlier, and change meaning you already knew that earlier. However, the situation has changed from what you had reported in the previous period. Probability is straightforward. That is the likelihood of that risk materializing, or in this example, there are 70% chances of that client leaving the organization, which is pretty high in terms of the probability. Okay. Included or not included in the previous forecast, you should have a track of that. Why? Because that will help you make adjustments to your next version of the forecast. If you have already made that adjustment in the previous forecast, you should know that that number was already baked in to your previous forecast. And say the risk reverses, you need to make sure that you remove that adjustment. Or in case the risk materializes, you may want to make some changes to the that adjustment that you need to do to the forecast. So was it included in the previous forecast is an important tracking line item or a tracking column that you need to have. And the current year impact is the dollar impact, that is that be there if the risk materializes. So in this case, if the client goes away, you will lose out $200,000 of revenues for that particular year or for that particular period. So this is how typically you track all the risk items and all the opportunities as well. So similarly, you could have an opportunity as well, and you make a list of all the risk items and all the opportunities, and you don't present all of them to the in your report. What you typically end up doing is you present the top five or the top 10 risk and opportunity items, which would have the most important or which are the most material ones that are important uh, for people to know in the organization. So
Asif,
in
there
the
are
next slide,
there are a couple of questions in the chat box. I think you want to take them. They are very relevant to the
I think
topic.
let me complete the risk and opportunity and
Okay,
then we can
okay.
take it. Okay, so I think in the next slide, what you will see is how would you present that. So the earlier slide was an Excel tracker. However, typically you present the top five, top three, top six, whatever you want to present in terms of as slides. So you will talk about, okay, these are the risk items, these are the opportunities. So this is what gets presented in the slide. That Excel tracker is usually a backup for you to refer. Okay, let me take a look at the comments or the chat box. Risk and opportunities, if not included in forecast, what will be the impact on reports or action? Okay, so if that risk has already materialized, and or alternatively it has very high chances of being materializing. Okay, and if you don't consider that in your forecast, or if you don't adjust your forecast for that, then your forecast may be, I would not say wrong, but it would be off by that particular, right? Because so typically what you do is you list down all the risk items, you list down all your opportunities items. Say you have 10 risk items, which totals up to, let me make sure that there is everybody on mute. Okay. So if you say you have 10 risk items, which totals up to say $5 million of risk, okay, and then you have 10 opportunity items, which is say $4 million of opportunities, okay, and you consider the probability and everything for each of them, and then you may decide, looking at all of them, to just make a top of the line adjustment of $2 million. Just so that is also what you could do. So typically, risk and opportunities, you would look at it and decide if you want to make an adjustment for that in the forecast or not. Okay, if you don't, typically your forecast might be just off by that particular magnitude. Is there a generally preferred industry standard nomenclature for color schema, particularly if there are greater line items? No, so there is no color scheme which is industry standard. So typically, you use your company brand colors or any other colors that are usually used. So what I've seen is you use the colors which your boss likes or your manager likes. So typically that is what analysts usually do or managers usually do. So if the CFO likes a particular set of colors, you typically tend to use that. So that is very, I would say, subjective. So there's no standard nomenclature or color schema that is it. Okay, so I think we've covered those questions. Let's see if you want to go to the next. Yeah, already covered the balance scorecard. We looked at the example. We looked at the KPI OKR example. So let's go to the
I think
next
we have covered
section.
them. Cool. So now that you realize, how amazing it would be to understand these high-paying skill sets, understand how management reports work, I'm sure all of you must be interested in grabbing those FP&A opportunities as well. We have been speaking to a lot of CFOs, and there are 5 critical skill sets that CFOs today are looking for in their finance team. Now, which are those 5 critical skill sets? One is the core FP&A concepts. That is your budgeting, your forecasting, your management reporting, different understandings of fixed and variable cost, revenue forecasting, different levels of cost forecasting. All of that is coming under the core FP&A concepts. And then comes financial modeling. Financial modeling, not the one which has investment banking or leverage buyout or valuation related. Financial modeling, which is specifically related to FP&A, where we are talking about revenue models, cost models, different kind of scenario planning, sensitivity analysis. All of that is financial modeling. And then comes data storytelling. Data storytelling is all about narrating your story. You may analyze 10,000 lines of Excel sheet, but how do you communicate that to senior management in the shortest possible time, the most effective possible manner? So that is what is data storytelling for you. And then business partnering. Business partnering is your ability to understand the business beyond your Excel sheets. Its ability to collaborate with various cross-functional teams, and then truly add value to the business. And last but not the least, leveraging the AI and technological developments that are happening in the finance function so that it can be far more effective and efficient in your finance function. So these are the core 5 skill sets that CFOs today are looking for in their finance teams. Now, what we have done at FPI is over the last couple of years, we have built a solid certification program. It's called Certified Global FP&A Professional Program. Now, it's a global FP&A certification built and delivered directly by CFOs and FP&A leaders. It has 10 comprehensive modules, which we'll talk about it in a while. And then everything is through experiential sessions, real life looking case studies, real life looking simulations from various sectors, various industries. You also become part of a global alumni network where FP&A program or CGFA program has been taken by students from more than 25 countries so far. So you become part of a global alumni network. You get sessions with a personalized career coach to help you tailor your FP&A career. Placement support, that's your resume review, your LinkedIn preparation, your mock interview prep. We keep conducting a lot of sessions for our students. We also have our own portal now. It's called fpnajobs.com. I'll share a few things about it later. That is where you can also create a profile and hopefully you get your next opportunity as well. Then monthly Q&A sessions where you can clarify any of the doubts or queries directly from the faculty. Access to guest speaker sessions. Globally, top FP&A experts, tool providers, automation experts come to FPI for a monthly guest session. And you get access to all of these guest sessions. And all of this happens through seamless access to an online best-in-class LMS. Live sessions are conducted on Zoom, so you can take it from the comfort of your home. And this is very thoughtfully designed for working professionals as well. Now, what is included in the CGFPA program? There are 10 comprehensive modules. Think about everything that you need for a solid FP&A role. It's covered in the CGFPA program. I'll let Asif cover the first 5 modules that you see on the left, and then I'll talk about the modules on the right.
Yeah, so starting from the introduction to FP&A, we cover basics. What does your typical FP&A week or month? What are the different items that you should focus on? In terms of then you go to the core modules, which are your budgeting, forecasting related modules.
Asif, you went on mute.
I think there's some background noise. Let me mute. Then after the introduction, we have the core modules of budgeting, forecasting, where we cover the important budgeting methods and forecasting techniques. So for example, budgeting methods like top-down, bottoms-up budgeting, zero-based incremental budgeting, activity-based budgeting, using examples and real-life case studies. Forecasting techniques like statistical methods of doing forecasting, driver-based forecasting. How is a traditional budget different from a rolling forecast? All of that is covered using examples and cases. Also, you go end to end from the revenue budget to the production and COGS budget to headcount and salary to R&D budget capex and depreciation. So all of the entire sequence of how do you prepare the budget for a real life looking organization. You go through it step by step, and at the end you come up with a presentation to the CFO for the budget, or you do a budget presentation to the CFO. That typically is a budgeting forecasting module. AI for FP&A is one of the popular modules which we keep updating every quarter, looking at the changes that are happening so fast in the field of AI. So there we cover large language models, your popular models that you typically are using on a day-to-day basis, be it your OpenAI, ChatGPT, or Perplexity, or Claude, or Gemini, Microsoft Copilot. So all of those are covered in that particular module. And what we do is you bring in finance related use cases. So we show you how you had done the same thing in Excel in the other modules, and how you could do the same process or same report or same activity using AI tools. However, in a much more efficient or a much more faster way. Also, we cover very specific AI agents which are used for specific FP&A functions. So there are specific tools for financial modeling, or there are specific tools for forecasting, specific tools for doing reconciliations. So there are specific AI agents very specific for very specific use cases. Also, the budgeting and the FP&A tools have now embedded AI interactive windows inside them. So just like you interact with Copilot in your Excel and PowerPoint, you have similar AI embedded features inside your FP&A tools, which are the popular tools which we cover in our module in the next one is again a very core module, the management reporting module, where we cover a lot of the things that we discussed today in much more detail, in much more using a lot many examples, case studies. So, for example, 10 different types of reporting. You may have maybe seen two or three today. There are more examples of management reports that we share. Um then we go deep into variance analysis. How do you do variance analysis? Different frameworks, different examples. How do you frame the commentary? What are the things that the senior management is looking for when you do variance analysis, profitability analysis? So some of those are important topics that we cover in the management reporting module. Financial modeling for FP&A. I think we already touched upon this in the previous slide, where we do very specific FP&A related activities. And how do you apply best practices in financial modeling to do a revenue model, or to create a long-term budget using capital budgeting techniques like NPV and IRR? Or how do you do scenario planning? How do you create the three different scenarios, base case, best case, worst case, for the same budget, and you can make the budget model dynamic? And how do you do sensitivity analysis? How do you do forecasting for cash flows for the next 1 month or next 12 weeks or next 13 weeks? All of those are covered in the financial modeling for FP&A. I think those are some of the core modules that I had to talk about. I'll let Dhawal cover the other ones that you see on the right hand side.
Thank you, Asif. Coming to the modules on the right, one thing that is common in your FP&A roles is that you will be dealing with large sets of data, whether it is financial data or operational data. And that is where you need to know your way to navigate through these large sets of data. So that's where we're covering in the data analytics module, the fundamentals of Power BI, Power Query, SQL, and other tools as well. We're adding more tools as well so that you are able to navigate your way through these data, and also become comfortable to start using these tools in your day-to-day FP&A roles and go beyond Excel as well. And now, do we claim to make you an expert in these tools? No, we at least take you to a level where you're becoming comfortable and familiar with these tools, and you start using these tools in your day-to-day FP&A function as well. And then comes financial analysis. Now, financial analysis is not just ratio analysis. There are plenty of different kind of analysis, mix, variance, different CFO level analysis that is required to internally support multiple stakeholders. That is where financial analysis module comes into play, where we cover different types of analysis, horizontal, vertical, mix analysis. All of that is covered in financial analysis module. Like I mentioned, you can analyze 10,000 lines of Excel sheets, but how do you communicate that into a cohesive presentation, a story, an effective insight to the business teams? That is what is storytelling and presentations module, where we're covering the entire storytelling and presentation best practices. Whom do you send? What kind of presentations? We practice that with practical examples as well. Now, strategy is a very interesting module. So as and when you start becoming senior in your company, your senior management will start talking in a certain strategic language. And at that point in time, you cannot use strategic terms in a loose way. So that's why we're covering all the popular strategic tools and also show you how they are interlinked with the FP&A function or how FP&A can contribute to these certain strategic decisions as well. Now, then comes business partnering. So business partnering is your ability to correlate and collaborate with multiple stakeholders. Now, Asif and I in our careers have collaborated with HR teams, marketing teams, legal teams, business development, and many more tools like many more examples like these. We share 7 to 8 good practical examples on business partnering of how you can truly add value to various cross-functional team members in your business. So that is what is business partnering. So all in all, 10 solid modules. Don't just think about this as a course or a certificate. It's your career accelerator. It is 20 years of our blood, sweat, and tears packed into a 6-month program. So that's the CGFPA program for you. Now, what is the eligibility for the CGFPA program? So one, you need to either have a bachelor's degree or a global equivalent in finance, accounting, or business. Alternatively, you may have your professional qualifications like CA, CMA, ACCA, or any equivalent accounting qualification of your respective country. So we don't claim to be a substitute for these primary certifications or primary qualifications, but in fact, we are a supplement to these qualifications because FP&A is something which is not necessarily taught in your CA or ACCA or any of these equivalent accounting qualifications. Now, how do you get the CGFPA certificate or CGFPA award? 3 things. One is that every Saturday we meet live for 2 hours. The next cohort is going to be from 6 p.m. to 8 p.m. IST, 6 p.m. to 8 p.m. IST, and you need to attend at least 50% of the classes live. After that, somewhere in month number 5, you will be submitting a capstone project, which will be an end-to-end CFO level presentation. All the guidance on that will be given to you. Don't worry about it. And once you submit that, then you will be eligible for the final examination. So the final examination is a 2 hours, 100 marks, proctored examination, which will be conducted online. And then after you clear the examination with at least 50% passing marks, you'll be awarded the CGFPA certificate from FP&A Professionals Institute. We are CPD UK accredited at this point in time, and you can claim your continuing credits in your accounting qualifications as well. So for a program like this, I mean, the ROI of a program like this, I leave it to your imagination. The course fee investment in this program is USD 1795. You can also pay that over 5 months. The course duration is 6 months, where all we expect is 3 to 4 hours of your time every week, 2 hours for the live sections, and about 60 to 90 minutes of your own preparation is required because we don't want to spend time on fundamentals. The time in the classroom will be used for quality discussions on case studies and frameworks. So that's where a little bit of self-study is also expected. Totally about 3 to 4 hours. Again, this is designed for working professionals. The next cohort is starting on 14th of March 2026. That's the orientation. Make sure that you complete your applications as soon as possible. The first round of applications are closing on 28th of February 2026, which is end of this month. The applications have already started. Okay, and make sure that you please fill in the application. Once you fill in the application, our academic counselors will reach out to you, check your eligibility, and also share with you the ongoing offers at that point in time. You may ask also for the demo lectures. You can also talk to any of our alumni. Don't just take our word for it. There have been tons of testimonials as well. So you can talk to any of our alumni, and they will tell you how the CGFPA program has been for them. Feel free to ask any phone numbers with our academic counselors as well. They'll share with you, and you can talk to any of our previous alumni as well. FP&Ajobs.com is our latest initiative where we are planning to bring FP&A talent and the employers on one platform. Please do make sure that you create a detailed profile on FP&Ajobs.com. Hopefully, your next opportunity will come from FP&Ajobs.com. Remember, the first round of applications are closing on 28th of February 2026. That's when the first round of applications are closing. The application process is completely free of cost, so make sure that it takes just 2 minutes, so make sure that you at least fill in the application and be in the race for the early bird offers or any ongoing offer at that point in time. Okay, we're open for questions now. I hope what we shared today was useful on the management reports, on the FP&A in general. Happy to take any questions that you might have on FP&A or about the program or about your finance careers in general. Okay, Asif has already shared the brochure link and the application form in the chat box. So make sure that you are able to complete that as soon as possible.
There's a question from Rama. So how many batches start in a year? So typically we have 4 cohorts in a year, each one after 3 months. So this one is in March and the next one will most likely will be in July. So you have January, March, July, and then October. So 4 cohorts in a year.
Okay, any other thoughts, questions on what we shared today, or about the program, or about anything in your finance career? Feel free to unmute yourself and ask a question. I mean, we still have some time.
When is the exam window for CGPA 2026? So again, exam window happens every quarter. So it is the same January, April, July, and October. So it is usually the first Saturday of the immediate first quarter of the month of first month of the quarter. So April is, I think, 11th of April, and then whatever the first Saturday of the July. So it's usually the first Saturday of the first month of that particular quarter. Okay, if you could find your basic, if you could, I could find in your website basic course for $100 and advanced for $397. So there are two FP&A certifications. One is a beginner level certification, which is a FP&A masterclass, which typically is for people who don't know anything about FP&A. So if you are a beginner and if you do not know about FP&A and if you want to explore FP&A as a career, the FP&A masterclass is a good place to start. However, if you have decided that you want to make a career in FP&A and you want to, or you've already started working in FP&A, then CGFPA is a good option, or it's a more in-depth and a comprehensive certification compared to masterclass. Okay, so I think there's some issue with the right in terms
I
of
just checked as if
the.
it's working for me. So George, if you can just refresh and check. I
Yeah, I
just
think
checked
you
that
need
the
to
job portal is working.
you need to make sure that you put the entire thing HTTPS, not just, so you make sure you put
Yeah.
the entire link. So I've just shared the link as well. Okay. I'm just checking if
Arun's
the
asking what is the rough cost of CGFP? I think we covered that, right? So
yeah.
the program is the program fee is USD 1795 for the live program, and usually there are some early bird offers that that depends on the cohort.
Okay.
And you can pay that
Asif,
over 5 minutes. I just want to, yeah.
yeah. So I would, what you can do is you can take a look at the brochure, go through the program details if you feel that this is going to help you in your career, and then you can fill up the application form, and we can then have the next conversation, which will be typically through the academic counselor. The CGFPA have same value in industry like CG. You want to cover that? I may not have a lot of
Sure.
context.
CGMA is a offering by SEMA, right? So we don't claim to be a substitute for SEMA or CMA or CPA or anything like that. Each of them have their own value. But remember, all of the other institutes like ACCA, CMA, SEMA, or any of these institutes are all 100-year-old or maybe 50-plus-year-old organizations. And we are just 2 years old in that sense. So it may not have the same brand advantage, to be honest, but it does a job in terms of helping you really get better at your work in FP&A, right? So you can just learn in whatever you are teaching is highly practical and industry practitioner oriented. Okay. Most of the accounting qualifications are your entry ticket into the corporate world, right? They don't help you after you start working in your careers.
Yeah, you want to share the top mate link? I'm just checking if I have that handy.
Let me just put our top meet link in the chat box. If you want any one-to-one counseling, if you want some time with Asif or me, so feel free to book a session with us. Share that link in the chat box. You can book some time with us, and happy to guide you in one-on-one as well.
Okay, all right. Thank you so much. We'll see you in one of our future sessions. Thanks, everybody.
Thanks, everyone. Bye-bye.